We are trying to break through decisively above 2,800, 2,813. That was the old lows that the old highs that we saw back in November. Let's just take a look at the sectors because nice leadership from technology doing well. Semiconductors up for the week. Emerging markets are having a very good week. Lagging this week, industrials, part of that is Boeing and the problem. And energy, which was another market leadership group, also a little bit lagging on the weekend today overall. I just want to show you the S&P 500. Remember this whole endless game about trying to get decisively over 2,800. 5 times we have failed here, and we're just sitting there right now. If we could break through, the old November 7th high was 2,813. We're sitting just above that right now. The old historic high back in September was 2,930. So we are, even where we are now, we are less than 4% from an historic high in the S&P 500. But you want to get above 2,815, right where we are now, and I think that would be a rather significant breakout. As for the earnings, I'm very interested in today's numbers because these are the first companies that have what you would call a February ending month. So they're sort of in the first quarter, even if they're not always necessarily first quarter numbers. So Broadcom here, we talk about a slowdown in China impacting them. They acknowledge that, but they maintain their full year guidance. That's what the street wants to see, maintain or increase full year guidance. Oracle beat, they raised the dividend, second straight quarter of revenue declines, so guidance a little bit disappointing on the revenue side. You see it's down. Adobe, same thing, a little bright light on the revenue there. So this is a little bit of a concern because the game here is stop the slide in earnings for the first quarter, second quarter, avoid so-called earnings recession, 2 consecutive quarters. This is the early guidance from very important companies with a February end. So I'd say this is very mixed today overall. Still haven't resolved whether we're going to have a negative quarter of earnings for the S&P 500 in the first quarter. This is a quadruple witching day. We already have a significant amount of volume right at the open, and we'll see even more at the close. I think the important thing is we're also a rebalancing day for the S&P 500 overall. So many companies are buying back stock actively, reducing their shares outstanding. Here are some really big ones. They are going to have their weightings reduced in the S&P 500 at the close today because they've been aggressively buying back stock. Pfizer's a huge buyback monster. They have reduced their shares outstanding by 30% in the last 7 or 8 years. Wells Fargo, another one. Broadcom, Citigroup, to a lesser extent, they'll have share count reductions at the close. Finally, just want to note, big study out by S&P this week on how managers, active fund managers, do against their bogey. They've been doing this for 16 years, and the numbers indicate it's very, very difficult, I would say almost impossible, to beat the indexes over long periods of time. So these are large cap fund managers. In this particular case, over 1 year, 64% do not beat the S&P 500. But go over long-term periods, 10 years, and the numbers are really big. 85% do not beat on a 10-year basis. 91% don't beat on a 15-year basis. And the key here is it doesn't matter what you're looking at. Fixed income, small cap, big cap, mid-cap. When you go over long periods, you can get fund managers who will beat over 1 to 2, maybe even 3 years, but long-term, almost nobody does. Look, mid-cap, 88% do not beat their bogeys after 10 years, 85% in small cap. The bottom line is, and this adjusts for survivorship bias, where a lot of funds that don't do well, they just throw them out. And this adjusts for all of that. Bottom line is very, very difficult to beat the bogeys over long periods of time. This was Jack Bogle's central insight over at Vanguard. Bogle was not against active management. Vanguard continues to have excellent active management firms, but Bogle noted that you have difficulty outperforming. He also noted that those who do outperform, often the fees they charge destroy the alpha that they create. Bogle's advice is that for most people, staying in low-cost index funds are the key way to go, and if you're going to have an active management, keep it low cost as well. And that's Vanguard's philosophy that they have held to even now after Jack Bogle's passing. Right now, we are just off the highs for the day, Sarah, up 25 points in the Dow.